Welcome to the Deep Dive, where we take the fire hose of financial information, the earnings reports, the footnotes, the analyst calls, and really distill it down into the core strategic insights you actually need to be truly well-informed. Today, we are plunging deep into the heart of global finance. We're analyzing the most recent earnings from the largest asset manager in the world, BlackRock Inc., ticker BLK.
And we're specifically breaking down their Q4 2025 earnings release, which hit the wires on January 15th, 2026. And this isn't just, a routine quarter.
Not at all.
This period was characterized by some really dramatic macroeconomic cross-currents. You had global interest rates finally transitioning from a hiking cycle to maybe a holding pattern.
Right.
And crucially, this intense burgeoning investment cycle around artificial intelligence was just starting to crest. And BlackRock, because of its sheer size, it doesn't just observe these trends, it mediates them.
So our mission today is very clear. We need to move far beyond the initial headlines and really understand the strategic transformation BlackRock is undergoing.
Right.
We're distilling everything from a structured 5-part earnings analysis report, pulling in the company's official data with real-time market expectations. So you walk away with not just numbers, but real insights into where this $14 trillion giant is headed.
And that concept of scale is just so central to the story here. BlackRock's assets under management, AUM, it now sits comfortably north of $14 trillion.
It's a number that's hard to even comprehend.
It is. To put that in perspective, that scale alone makes BlackRock a macroeconomic force that's larger than the GDP of all but, a handful of nations globally.
In this specific quarter, Q4 2025, it felt like a critical inflection point. It was the first big report where the firm had to show that it was successfully integrating its, frankly, aggressive private market acquisitions.
Yeah, the big ones. Global Infrastructure Partners, or GIP, and HPS Investment Partners.
Exactly. So the questions were, are these deals actually adding value? Did they break the bank? Did the operational engine, survive swallowing these huge companies?
And the initial signal, which we want to put right up front for you, is that the results showed a definitive double beat. They surpassed Wall Street's expectations on both revenue and adjusted profit.
Which is a huge validation.
It validates the resilience of the platform, and it confirms that their strategy, this big pivot into higher margin private assets, it's working, even while they're still digesting these massive transactions.
Okay, so we're going to spend a lot of time dissecting the quality of those earnings and revealing how the mechanics of their operating leverage held up, because there was a very, very noisy gap statement.
A lot of noise.
Okay, let's unpack this and separate the signal from the noise, starting with the immediate data. That headline double beat is the perfect place to start. It means BlackRock outperformed what everyone was expecting on both the top-line revenue and the bottom line, which is profitability. So let's dive into that revenue first, because it was remarkably strong.
It really was. Total revenue for the fourth quarter of 2025 came in at $7.008 billion. Now, that's not just a big number. It represents a highly robust year-over-year growth rate of 23.4%.
Yeah.
That's up from $5.677 billion in Q4 of 2024. This kind of growth, it's not just the market lifting them up. It signals a real fundamental expansion of the revenue base.
And that figure wasn't just good, it was a strong surprise to the upside. The $7 billion comfortably surpassed the Wall Street consensus estimate, which was around $6.75 billion.
By about $258 million.
That's a 3.8% positive revenue surprise. For a company of this scale, that kind of beat implies they are capturing both the upside from rising markets and they're monetizing these new revenue streams from GIP and HPS faster than anyone predicted.
Okay, now here's the section that really requires some forensic attention. It's the most critical area for anyone drilling down into the metrics. What we're calling the profitability paradox. This is the chasm between the GAAP and the adjusted numbers. The generally accepted accounting principles, or GAAP, net income, it was reported at $1.127 billion.
Wait a minute, that GAAP number, the one that usually hits all the big headlines, that actually represents a significant year-over-year contraction of 32.5%.
Right.
It was down from $1.670 billion a year ago. For a company that's posting 23% revenue growth, a 32% decline in GAAP profit is.
Yeah.
It's not just alarming, it screams distress. How do we reconcile that steep of a decline with the story of a successful quarter?
And you've highlighted exactly why we call that the red herring number in this context.
Okay.
A superficial reading of that gap contraction would lead you to a completely flawed conclusion about BlackRock's underlying health. The why is that the gap figure is just weighed down by these large, non-cash, non-recurring accounting charges directly related to the M&A activity.
So these aren't costs from the day-to-day business failing.
Not at all. There are not costs associated with failing operations.
So we have to look past the official accounting statement to see the real economic engine underneath.
Precisely. When you strip away those specific one-time or non-cash items, which we're going to detail in the next section, you reveal the true economic earnings power. The adjusted net income stood at a very strong $2.176 billion.
Okay, that's a huge difference.
It is. And crucially, this represented a healthy 16.1% increase from the $1.874 billion reported year over year. That billion-dollar difference between the GAAP and adjusted figures, that is the entire story of this quarter.
That swing is absolutely remarkable. I mean, to go from a reported 32.5% loss in GAAP profitability to a 16.1% gain in adjusted profitability, it just underscores how much noise these strategic acquisitions have introduced into the accounting.
And that divergence is clearest when we look at the earnings per share, or EPS metrics. This is the primary yardstick investors use to gauge shareholder value. The reported, or GAAP diluted EPS, was $7.16.
Right, reflecting that steep 32.6% YoY decline.
But the adjusted diluted EPS, the metric that's focused on the recurring business performance, came in at $13.16.
13.16. Okay, so that represents a 10.3% year-over-year growth rate from $11.93 in the prior year. And that adjusted figure, it comfortably surpassed the consensus estimate of $12.44.
Right, which constitutes a positive earnings surprise about 5.8%, or 72 cents per share. That's a very solid earnings beat. It confirms the momentum of the underlying core business.
It's important for us to pause here, though, and really dissect the role of the share count. Because the per-share metrics are affected not just by the total profit, but by how many shares are out there.
Exactly. We need to clarify the difference between basic and diluted EPS for anyone looking closely at BlackRock right now, because it's a key detail given their aggressive M&A strategy.
So basic EPS, that just considers the common shares that are currently outstanding, right?
Yes, but diluted EPS, that's the superior metric for a prudent investor because it incorporates the potential impact of all dilutive securities, stock options, convertible debt, and, in this case, all the equity they issued for these transactions. It paints the worst-case scenario for ownership dilution.
And in Q4 2025, BlackRock's weighted average diluted share count was 165.4 million.
That's significantly higher than the basic count of 155.1 million.
Right. That 10.3 million share difference is the dilutive impact of equity-based compensation and, critically, the equity issued to fund the GIP and HPS deals.
So the market, which usually looks past this kind of short-term noise, it clearly focused on the strong signal.
It did. In the immediate post-release trading session, the stock price surged. It closed at over $1,151, a single-day gain of 5.42%.
And that reaction confirms that the big institutional analysts saw that 16% adjusted net income growth as the true measure of health, validating the whole private market's pivot.
Exactly.
So let's dig into a critical analytical insight here. Total revenue growth was 23.4%. Adjusted operating income grew at a near-matching 22.4%. That confirms highly positive operating leverage, meaning for every new dollar of revenue, almost a dollar is dropping to the profit line.
Very efficient. But the adjusted EPS grew at a much slower pace of only 10.3%. If the operations are so efficient, why is there such a large divergence in those growth rates?
This is the essential analytical insight of the quarter, the compression in earnings growth relative to the top line. It's not a failure of execution or efficiency. It is a calculated mathematical outcome of that share dilution we just talked about.
So the company is still running an incredibly efficient machine, but that efficiency is being spread across 5.4% more shares than it was a year ago.
That's it exactly. That 5.4% year-over-year increase in the diluted share count is the direct cause of the gap. This increase is primarily because of the equity they used as currency to fund those transformational GIP and HPS acquisitions.
So management made a conscious strategic trade-off.
A very conscious one. They minimized debt financing by using their own stock, but in doing so, they intentionally inflated the denominator in the EPS calculation.
So they willingly sacrificed near-term EPS velocity, how fast EPS grows, in exchange for long-term platform expansion and, future higher margin growth from private markets.
It's a classic strategic corporate finance move. It penalizes short-term per-share metrics in favor of a long-term structural improvement. And while BlackRock did execute $1.6 billion in share buybacks for the year, that just wasn't enough to offset the sheer volume of shares they had to issue for deals of this magnitude.
So this dilution is really the necessary price of admission for establishing this dominant position in the high-fee, high-barrier-to-entry private market space.
That's the perfect way to phrase it. It's the price of admission.
I hear the strategic rationale, but isn't there a risk that the market, or maybe just retail investors and momentum traders, will still over-penalize them for a 32% gap decline, no matter how good the explanation is? How do we know this narrative of strength will actually stick?
That's a crucial point, and it's why institutional analysts exist, right? They are sophisticated enough to immediately spot the quality of the earnings by looking at the reconciliation tables. The fact that the stock surged 5.4% right after the release confirms that the majority of capital was focused on the adjusted metrics. They are confirming the efficiency and the strategic value. The narrative sticks because these non-cash charges are transparently accounted for and they are demonstrably non-recurring.
So the key, which we're about to address, is detailing exactly what drove that massive gap divergence.
Exactly.
All right, now we're moving into the actual plumbing of BlackRock's immense strength. And that is its massive scalability, the ability to add billions of dollars in AUM with just minimal incremental cost.
But before we celebrate that, we absolutely have to address that massive margin gap we saw in the headlines.
Let's start with the alarm bell then. The reported GAAP operating margin was 23.7%. That is a brutal contraction from 36.6% in the prior year period.
Yeah, if this were a simple operating business, you'd assume a catastrophe, like pricing collapsed or cost control completely failed.
But the reality, as confirmed by those adjusted metrics, tells a story of core operational stability. For efficiency metric, the adjusted operating margin, it remained robust at 45.0%.
Right, which is a negligible, really healthy compression from 45.5% a year ago. The entire analytical discussion of this quarter rests on understanding that huge 2,100 basis point gap between 23.7% GAAP and 45.0% adjusted.
So the gap is driven by specific, distinct, non-cash and non-recurring events.
Exactly. The takeaway for anyone analyzing complex financial firms is this. These adjusted results are not masking poor fundamental performance. They are simply excluding costs that are structurally unconnected to the actual recurring operations of running the core asset management business.
Okay, so let's walk through the four major adjustments that bridge the GAAP operating income of $1.661 billion to that much healthier $2.848 billion in adjusted operating income.
Let's do it. Let's start with the single largest and most complex adjustment. The $455 million impact from the change in fair value of contingent consideration.
Okay, what does that even mean? It sounds bad.
It sounds bad, but it's actually, and this is the paradox, it's actually a good sign.
How so?
It relates primarily to the structure of the GIP acquisition. When BlackRock structured that deal, they didn't just pay a fixed price, they likely included a performance element, the contingent consideration.
Meaning they promised the former GIP owners additional payments if the business hits certain ambitious targets over the next few years.
Precisely. And the paradoxical insight here is that an increase in this liability is actually a positive business signal.
Right.
Accounting rules mandate that BlackRock has to reevaluate the fair value of this future liability every single quarter. If the acquired business, GIP, is performing better than expected, hitting more home runs, winning more mandates, the probability of BlackRock having to pay out that future bonus increases.
So they're then forced to book that increased probability as a large non-cash expense on the income statement now.
Exactly. The $455 million expense doesn't mean cash went out the door. It means the acquired business is doing so well that they must reserve more for a future bonus payment.
So the expense signals success, not failure. That's a vital distinction. What was the next major cost hitting the DAP statement?
That was $315 million in acquisition-related compensation costs. This expense really highlights the nature of these asset management deals. When you acquire human capital-intensive businesses like HPS and Precon, the primary value is the intellectual property, in the people and their client relationships.
Right. So this $350 million covers non-recurring retention bonuses and things like that.
Exactly. Deferred compensation structures.
And this cost is necessary, right? You have to pay the money to ensure the key portfolio managers and deal makers don't just walk out the door after the deal closes, which would instantly erode the value of what you just bought.
Precisely. It is essential for preserving the acquired value. And because these retention payouts are structured as non-recurring, one-time incentives tied to the M&A, analysts remove them to gauge the cost of running the regular recurring BlackRock platform.
Then we have the classic accounting charge that always confuses people. amortization of intangible assets, hitting the books for $268 million.
And this is a purely non-cash expense. Think of it like paper depreciation. When BlackRock buys GIP, it assigns value to intangible assets like the GIP brand name, client lists, or specialized technology, the things you can't physically touch.
And over time, accounting rules require BlackRock to gradually write down the value of these assets on the balance sheet, reflecting that expense on the income statement.
Correct. It's a necessary accounting entry, but has zero impact on BlackRock's actual cash flow or liquidity. No physical check is written for amortization. It's entirely a journal entry.
And finally, the discretionary item that hit the P&L for $109 million, the charitable contribution. This is clearly a one-time event.
It is. BlackRock contributed a portion of its stake in Circle Internet Group, Inc., a digital asset firm, to the BlackRock Charitable Fund. It's a discretionary one-time allocation of an asset, not an operating cost required to manage client funds.
So it's rightfully removed to calculate the adjusted operating view. It confirms it wasn't a distraction from their core financial mission. So when we total those four adjustments, the contingent consideration, the retention comp, the amortization, and the charitable donation, we fully account for that massive $1.187 billion gap between GAAP and adjusted operating income. The core efficiency of 45.0% is absolutely confirmed.
And we should also acknowledge the tailwind provided by tax efficiency. The GAAP effective tax rate was 23.9%. However, the adjusted effective tax rate was significantly lower at 20.2%.
Okay.
This benefit came from discrete tax efficiencies, including about $29 million related to that charitable contribution. This lower tax rate means more of that operating profit dropped to the bottom line, providing crucial support to that 10.3% adjusted EPS growth rate.
So the bottom line on this comprehensive look at profitability is the confirmation of positive operating leverage. Despite absorbing all the complexities and acquisition costs, the fact that adjusted operating income grew by 22.4%, almost matching the 23.4% revenue growth, is the critical takeaway.
It confirms rigorous cost discipline and the deep scalability of the BlackRock model. It means that the incremental revenue they are now earning, particularly from those higher margin private market deals and the growing tech services segment, is flowing efficiently to the bottom line rather than being eaten up by uncontrolled overhead.
So the engine of profitability is not just running, it's running cleaner than ever once you clear away all that M&A debris.
That's a great way to put it.
Okay, let's transition now to the source of that $7 billion in revenue. This is where we can really visualize the sheer magnitude of the BlackRock platform.
The scale, as we noted, is just unrivaled. Total AUM hit a record $14.04 trillion. That's a 22% increase year over year.
And that growth comes from two main things, right? The beta effect, just markets going up, and then incredibly strong organic net inflows.
That's right. And speaking of inflows, the quantity is staggering. Total net inflows for Q4 were $342 billion. To gather assets at that rate in a single quarter is a monumental feat that just reinforces BlackRock's dominance in asset gathering across every single channel.
Can we break that figure down?
We can. So $268 billion of that was long-term net flows, which represents assets clients commit for, durable, longer periods. The remaining $74 billion was in cash management net flows, which, while more temporary, provide that essential insight into global liquidity we mentioned earlier.
But to understand the future, we really need to analyze the quality of these flows by the type of product.
Exactly. Let's start with the largest component, the core pillar, equity.
Okay.
Equity is the bedrock. It commands $7.794 trillion in AUM and generated $2.530 billion in base fee revenue. That's almost half, 48% of their total base fees.
And it attracted $126 billion in net inflows.
Right, driven heavily by this relentless demand for iShares ETFs as investors sought exposure to the global equity rally. We should also note the strong contribution from systematic active equities, which validates BlackRock's significant quiet investments in quantitative strategies that often fly under the radar.
Okay, next up is fixed income, which has played that crucial role of the yield aggregator as rates finally stabilized.
Correct. Fixed income holds $3.272 trillion in AUM and generated over $1 billion in base fees, about 20% of the total. Importantly, it generated $84 billion in net inflows.
And that's a substantial flow.
It is. It demonstrates how investors across institutional and retail used BlackRock to lock in newly attractive yields across the entire credit spectrum. Their breadth allows them to capture flows no matter where investors are choosing to park their duration risk.
Now let's talk about the segment that justifies the entire strategic pivot, alternative. This is the high-octane growth engine.
This is, without question, the most crucial part of the strategic narrative. Alternatives only make up a small fraction of their portfolio, about 3% of total AUM, or $424 billion.
Yeah.
But they generate a disproportionate 16% of total base fees, which was $847 million in Q4.
That fee leverage is just profound. A dollar of AUM in alternatives is exponentially more valuable than a dollar in a low-cost index fund.
It's like selling bespoke, custom-tailored suits versus selling mass-market T-shirts, and BlackRock is intentionally shifting towards the bespoke side of the business.
Precisely.
And within alternatives, the private markets subsegment alone contributed $663 million in revenue. That massive fee leverage is the entire strategic rationale behind the aggressive acquisitions of GIP and HPS. They are buying margin expansion and revenue stability that is less dependent on daily public market fluctuations.
Can we break down what GIP and HPS specifically bring to that alternatives table?
Absolutely. So GIP, Global Infrastructure Partners, brings deep expertise in large-scale, real assets, think ports, airports, midstream energy pipelines, and crucially, massive renewable energy farms.
These assets offer inflation protection and predictable long-term cash flows that are highly desired by large pensions and sovereign wealth funds.
Exactly. And HPS Investment Partners, on the other hand, specializes in private credit direct lending, distressed debt, and structured credit solutions.
So BlackRock is buying a full-stack solution. GIP provides the real assets and the infrastructure equity, while HPS provides the private debt side of the capital structure. This connects directly to those future fundraising goals that Fink laid out.
It does. They're building a unified private markets machine designed to capture capital from institutional investors who are consolidating their relationships with fewer, bigger managers.
Let's pivot to technology services, often just called the Aladdin platform. This is the recurring revenue moat that provides incredible stability.
Technology services brought in $531 million in revenue, which is a significant jump from $428 million in the prior year. This revenue stream is critical because it's subscription-based. That means it's less volatile and less correlated with the daily movements of the stock market than base fees are.
That $103 million year-over-year increase needs some context, too. A portion of that growth, about $65 million, came from the Preqin acquisition. What does Preqin provide that makes it so valuable?
Preqin is a global leader in providing private markets data and intelligence. For BlackRock, integrating Preqin isn't just about adding a revenue stream. It enhances their capabilities in due diligence and pricing across the whole alternative segment.
It gives their managers superior insights.
Exactly, and it allows the Aladdin platform, which is the core operating system for institutional investors globally, to integrate these illiquid assets seamlessly alongside liquid ones. It's an intellectual moat that few, if any, competitors can replicate.
Okay, now let's re-slice the data by client type, starting with the iShares ETF business, which remains the indisputable crown jewel.
iShares is the volume machine. It accounted for $2.279 billion in base fees, that's 43% of the total, and gathered a spectacular $181 billion in net inflows.
That's incredible dominance.
It is. It demonstrates that the ETF wrapper, which BlackRock pioneered and refined, remains the preferred vehicle for modern portfolio construction, whether clients are looking for risk-on equity exposure or yield-seeking fixed income.
Looking at institutional clients, the flows were more modest at $5 billion, but the fee quality here is the story, not the volume.
Precisely. Institutional generated $1.426 billion in base fees. The modest total flow figure obscures the fact that active institutional strategies generated $1.167 billion in fees, vastly outperforming their index strategies in that channel.
So that reinforces the enduring value of these bespoke, high-touch, active management relationships with big pensions and sovereign wealth funds. They're selling solutions, not just products.
That's the key. And finally, retail clients showed a very strong resurgence, which suggests their push into wealth management channels is really working.
How strong was it?
Retail base fees were $1.243 billion, and they gathered $82 billion in net inflows. This resurgence indicates successful penetration into key wealth management channels, particularly via the widespread adoption of model portfolios by financial advisors.
So advisors are increasingly using BlackRock's core building blocks to construct diversified client portfolios, creating a sticky, reliable revenue stream for BlackRock. So the segment data confirms that BlackRock is running a perfectly synchronized multi-engine machine. You have iShares gathering the scalable low-cost assets, technology providing the stable high-margin moat, and alternatives offering the high-margin strategic growth path that defines the firm's future.
It's a beautifully constructed value chain, and the Q4 numbers validated that all parts of the machine are running efficiently at the same time, all while digesting these acquisitions without any indigestion.
BlackRock's balance sheet.
Yeah.
It needs to be viewed not just as an accounting ledger, but really as a strategic weapon. It's the source of financial durability that funds M&A, aggressive tech investment, and massive capital return all at once.
That financial durability is what allows them to undertake these, audacious multi-billion-dollar acquisitions. And while we focus on the income statement, it's worth noting the sheer liquidity profile. The firm manages $1.08 trillion in client cash management assets.
And to be clear, that $1.08 trillion isn't BlackRock's corporate cash.
No.
But managing that colossal pool of client liquidity gives them deep, real-time insights into global cash flows. It acts as a powerful intelligence network and a natural business hedge.
And crucially, the fact that they executed cash and stock transactions for GIP and HPS without putting any real strain on their credit rating confirms they have immense borrowing capacity. And most importantly, the strong underlying cash flow generation that those adjusted metrics reveal.
Now, let's look at capital return, which is the management team's direct vote of confidence in the future. Capital returns is delivered through dividends and share repurchases.
Starting with dividends, the board approved a robust 10% increase in the quarterly cash dividend. They raised it to $5.73 per share.
A double-digit hike like that is a massive signal.
It is. Management does not raise the dividend by 10% unless they have supreme confidence in the sustainability of their future cash flows. They believe the GIP and HPS integration will be accretive quickly enough to easily support that higher payout.
So that 10% hike is a very powerful forward-looking statement for shareholders. Now, turning to share repurchases, we know they caused dilution with the deals, but they also bought back stock.
They did. For the full year 2025, BlackRock repurchased $1.6 billion worth of its own shares. When you combine that with $3.4 billion in dividend payouts, the company returned a total of $5 billion to shareholders in 2025.
That's a significant multi-billion-dollar commitment to distributing cash flow.
It is.
But the real question for investors who are worried about dilution is future capacity. Can they offset that M&A share issuance going forward?
That's where the board's new authorization comes in. They authorized the repurchase of an additional 7 million shares. At the current post-earnings stock price, that represents approximately $8 billion in potential future buying power.
So that authorization provides a massive backstop for the stock price and a clear stated mechanism for management to offset the share dilution from the recent deals over the next few quarters.
Right.
So slide 4 shows a company balancing two core priorities: aggressive investment in high-growth assets like GIP and HPS, with a confident distribution of current cash flow, demonstrating real financial maturity.
Absolutely. They are signaling that the capital structure remains a fortress. They're leveraging their scale and cash flow to make these transformational deals while simultaneously rewarding patient shareholders. It's a classic indicator of a financially disciplined growth company.
Let's turn to the future and the strategic narrative, which CEO Lawrence D. Fink is using to frame the company's next phase.
Fink framed Q4 2025 not as a finish line, but as a launch pad. He emphasized the accelerating momentum across our entire platform, highlighting that clients entrusted them with an incredible $698 billion in new assets throughout the full year 2025.
And that sets the stage for 2026 to be the first full year operating under what he's calling the unified platform.
That unified platform is the core strategic concept. It signifies BlackRock moving beyond being perceived purely as the dominant asset gatherer for passive funds, the iShares business, to positioning itself as a comprehensive whole portfolio solution provider.
So the platform's ultimate goal is to converge public and private markets into a single client offering.
Right. This means actively integrating GIP for infrastructure equity, HPS for private credit, and Prekin for private markets data so that institutional clients no longer need to go to separate providers.
They aim to own every segment of the investment value chain, creating a seamless connection between the highly liquid ETF world and the complex, illiquid world of private assets.
Exactly. And Fink provided a specific, highly quantifiable commercial goal for investors to track the success of this platform. He targeted $400 billion in private markets fundraising by 2030.
And that is the most important future key performance indicator, or KPI, mentioned in the entire release, isn't it?
I think so. It transforms the qualitative story about private markets into a hard, measurable target. Investors can now benchmark the success of the GIP and HPS integrations, not just on fee revenue, but on the firm's ability to actually attract a staggering $400 billion in new private capital over the next 4 years.
It gives analysts a clear metric to gauge whether this whole portfolio vision is translating into real capital capture. Okay, let's synthesize everything we've covered across these 5 slides into the key takeaways. What are the most important nuggets we want everyone to remember?
First, remember that the beat was real and high quality. The underlying operational performance was excellent. It wasn't just achieved through cost cuts or market luck.
It was driven by the $342 billion in Q4 net inflows, coupled with 12% organic base fee growth. That proves operational excellence and accelerating client demand.
Second, private markets are the new growth engine. The GIP-HPS acquisitions fundamentally changed the business model. With 16% of base fees coming from alternatives on only 3% of AUM, the margin expansion story for the next decade hinges entirely on Think hitting that $400 billion private markets fundraising target.
That's where the premium profits are going to come from.
That's right. Third, the ETF juggernaut provides ballast. Even with this big pivot, the iShares franchise gathered $181 billion in Q4 flows. This is the crucial, steady, scalable, and reliable cash flow generator, the volume business.
And that's what funds the venture into those new, higher margin, but inherently more complex private territories. Without the iShares scale, the private markets pivot would be a far riskier proposition.
A much riskier bet. And finally, the point we spent significant time analyzing. Dilution is a temporary cost. The divergence between the 23% revenue growth and the 10% EPS growth is simply the price of admission for acquiring GIP and HPS.
So investors are accepting near-term dilution, that lower EPS for a significantly more diversified, structurally higher margin and resilient platform in the future.
And when you put all this together, BlackRock really stands as a category of one. They are uniquely dominant across ETFs, active management, technology via Aladdin, and now private infrastructure and credit.
And the market's 5.42% positive reaction confirms that investors believe in this whole portfolio vision that Larry Fink articulated. They have successfully established their position for the next decade of institutional capital allocation.
I think that's right.
That provides a huge amount of context on the actual value drivers behind the press release. So here's a final provocative thought for you to consider. Based on this deep dive, how will BlackRock's new strategic goal of raising $400 billion in private markets by 2030 change the competitive landscape for traditional pure-play public equity firms, the KKRs and the Blackstones of the world, that lack the massive indexing scale, the deep balance sheet, and the extensive client distribution network of iShares? Before we wrap up, we need to provide a couple of important disclaimers.
Financial disclaimer. This information is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be based on your own research and in consultation with a qualified financial professional.
AI disclaimer. This report was generated by an artificial intelligence model, integrating data from the company's official earnings press release with publicly available market data. All information should be independently verified. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.